Welcome everyone to this another episode of Connecting Dots. I am Shubham Vaishnav, part of the Indirect taxation team of Cygnet 1. With me, I have Tapas Ruparelia, who leads our domain and consulting team. Welcome, Tapas.
Thank you, Shubham. So, Shubham, my suggestion is rather than discussing the rates, let's discuss some other changes. And in fact, I am pretty sure there are so many changes that would have somewhere hidden in all those releases and updates that have come in. Let's discuss some changes which are other than the rate changes.
For sure. So, starting with the GST Council is calling it GST 2.0. Why is it so? Why is it 2.0 and not the changes only?
So, I think from the introduction of GST in 2017, this seems to be the biggest reform. You understand the GST when it came in, it had 4 slabs. Merging these 4 slabs into just 2 slabs, 5% and 18%. And of course, we'll leave the nitty-gritties of having those small other rates also. But consolidating 4 rate slabs into 2 rate slabs is a huge change that has been done, and that it has actually taken 8 long years. So it was a big leap, which the government wants to call it as GST 2.0. And of course, the way this government is, they would want to package it into something which is really interesting, right? Normally it is said that you should not read a book by its cover, but unless and until you name something really good, I don't think so you are going to pick up a book from a bookshelf. It's similar to that. If you name an amendment as too good, then only it has an impact.
Correct. So how will you describe this 2.0, the changes in a very short? What was the motive behind these changes?
So these rate changes were always on the card. The government did constitute a rate rationalization committee long back. That committee came back to the GST Council with its suggestions a couple of times. But then again, while within the discussions that happened in the council, it was referred back to the rationalization committee. And I think it's time now when everybody came onto a single conclusion and this happened. So it's not a one-off thing that the government suddenly stood up and realized that, the US has imposed so much of tariff on us and let us do something to boost the consumption within the country. Of course, that's one of the motive for sure. But this was always on the cards and it has been in the works for a long period of time. It's just that it has been implemented now.
Right. So this simplification, will it reduce the litigation and the disputes, or will it emerge new disputes?
I think you're referring to the classification disputes. In the very long term, say after 5 years, 10 years, the litigations might come down because you then have a lower number of slabs to look at. But in the interim, I think the way when GST came in, we said that there would be a revenue buoyancy. I feel that the interim period when the GST came in, there are still a lot of issues that are going on as to what falls under 5%, 12%, 18 or 28. Right. Because there is a sudden change and there has been an overhaul as to 5%. Some of the entries of 12% has gone into 18, some has gone into 5, even some of the entries of 5% has gone into 18, so on and so forth. So because of this entire reshuffle, the interim period, or which is the transition period, might have a lot of challenges which might settle down after a couple of years. But I feel that this interim period where the changes have happened, probably it might give a rise to certain classification challenges. And in fact, since the 8 years, I think we have seen a couple of advance rulings here and there. Yes. But as such, the classification dispute as such has not come into the light as it should be. And I expect that the next wave of litigations would be around classification. Yeah.
Yes, very rightly said. So let's coming on to refund, which is again has seen a very major reform. I am calling it a major reform because the provisional refund which was issued for zero rated supply before is now the scope has been increased to inverted duty structure also. So inverted duty structure was something which was always very hard to get. Like you have to prove each and every step to the department and then you get it. But now the department is increase the scope of a provisional refund along with a risk-based profile. So what is this risk-based profile, how it will be determined, and what is your take on inclusion of inverted duty structure in the provisional system?
So this particular amendment I think is amazing, and it goes within the overall intent of the government to simplify compliances for small taxpayers. In fact, the simplification of refund process and granting of 90% of refund for export was there. It was announced a couple of years back, but has not been followed in its true spirit. Inclusion of IDS, of course, inverted duty structure is a very good sign and a very good indication, because as you rightly mentioned that getting an inverted duty structure refund is really hard. Secondly, they have mentioned a condition that they will have a risk-based assessment of the assessees, and those who are considered as risky exporters or risky taxpayers, only in those cases the 90% refund will not be granted, otherwise it would be granted. This, if implemented in a letter and spirit, I think it's going to be a huge relief for the trade and industry. The people will start getting refund, at least 90% of it immediately. And coming on to your question as to what would be the condition of risk-based assessment, I think that's not clear. Once this, I think they have announced that they'll announce the respective procedure with respect to this by the 1st of November. Right. Once it comes in, I believe they would also put in all the condition as to what would be a risky taxpayer and what would be the assessment cases. I personally feel that it would be definitely linked to certain industries which are prone to a lot of tax evasions. Also the specific products which are prone to tax evasions. We have seen that for exemptions, etc. also there are certain industries which have a very specific use cases. For example, scrap sales, not exemptions, but just to take an example, for scrap sales, there is a TDS that happens, because that is where a lot of tax evasion happens. So industry as well as very specific to goods and services, they would find out. And probably if, let's say, you are purchasing from certain vendors who have been marked as those notorious vendors, or you have been not very regular in filing your returns, in those cases you would fall under those risky exporter or a risky assessee who would not get the 90% of the refund, provisional refund.
I have seen some changes in post-sale discount. Can you share some insights on what are the changes and what was the controversy around it?
So what was happening when the GST law was introduced, the way section 15 was drafted, is that it said that if you want to give a discount to your customers after issuance of an invoice, then there has to be an agreement that you have to decide in your agreement as to the conditions with respect to under what scenarios or what conditions you would make those issue those credit notes, and the recipient would be allowed to make that reversal. Now, specifically to pharmaceutical and FMCG industry, this happened that many a times when a sale was made, a dealer would give a discount or the manufacturer would give a discount to the dealer and ask them to sell it at a lower price. So I would have removed my goods and raised an invoice on 100, but then I am asking my dealer to sell certain goods for whatever reasons. In case of pharmaceutical, probably I would want to give some discount, or I would want to clear the stock which is expiring. Similarly, in case of automobile industry also, I would want to achieve my targets and clear some stocks at least at the quarter end, or for whatever reasons. And in order to boost sales also, I might want to give a lot of discount to my dealers. In those cases, there was always a gray area as to whether that discount has been pre-agreed or not before the sale has happened, and it was very difficult to prove as to whether this agreement or an understanding was there in order to pass this. Then what happens when you raise a financial credit note and you don't want to reduce it? The main question that came in was, number one, whether this credit note can be raised under section 15, and then there was another gray area which said that because the supplier or the manufacturer is giving a discount to the dealer to boost the sale, it is an indirect consideration of sorts to the dealer for providing us services to increase the sale somehow. That is somewhere a lot of interpretations that came out in couple of advance ruling. To address this, I think number one, they have made an amendment to section 15. That is something that has been proposed. But simultaneously, they have also issued a circular where they have said that because of this post-sale discount, if you are issuing a financial credit note, we are absolutely not worried, because anyways the tax has been paid and on which the dealer is taking the credit. If still a post-sale credit note is being issued where the tax is also being adjusted, and that is only limited for the purpose of giving a discount which is being passed on to the dealer. There also they are saying they don't have any problem. Only challenge that they are highlighting is that if because of this discount, the credit note that is being issued, if the dealer is ultimately doing some promotional activities because of which the manufacturer is ultimately getting benefited, only in those cases it might be considered as a supply from the dealer to the supplier, and they might want to bill it. So in a nutshell, they are doing away with almost all the controversies that existed because of the tricky language of section 15, and they have tried to resolve it. Of course, a very welcome move from the government.
Right. Coming to the GST registrations. So government has proposed a new scheme for small and low risk taxpayers. So what is this scheme about?
So with this registration, I think there are two major amendments. Let me deal with the one that you just mentioned about. I think getting a registration in GST is the biggest challenge. Practically, if you want to get a registration under GST, I think it's a nightmare, whether it's for the taxpayers or for the assessee. And I think government has taken into consideration the representations that have been made. And what they have said is that micro, small and medium enterprises, which are there, small businesses in a plain language, what they are saying is, which is actually 96% of the registrations that are being taken across the country. They're going to come up with a simplified registration mechanism. And by following this simplified registration mechanism, I think people would start getting registration, say, within 3 to 7 days, which I think currently takes probably months in a lot of cases. So that is the basic idea. Of course, the scheme will come in detail when they release it. Right now, this is the only information that we have, that a simplified registration scheme is going to come. And if it is actually followed in its letter and spirit, I think it's going to be wonderful for the GST purpose.
That brings me to my next question, which says a simplified registration scheme is introduced for small suppliers of e-commerce. So what is this scheme all about?
Very interesting question, Shubham. In fact, we have a lot of customers who use our portal, who are in the e-commerce business, and they keep raising this point a lot of times. We have discussed, and I think a lot of representations have been made from the government. So what happens is, say I am selling something on an e-commerce platform. Now my goods go from my factory or my shop onto the e-commerce platform's warehouse, and based on their internal algorithms, they predict the demands. Now, if say I am in Gujarat and my goods have gone into one of the warehouse of this e-commerce operator in Gujarat, they might have predicted that a huge demand is going to come up in, say, the state of Maharashtra. They do a transfer from their warehouse in Gujarat to their warehouse in Maharashtra, but the title of goods doesn't get transferred. In that case, although the goods belong to me, the goods have moved into Maharashtra. Technically, I have to have a registration in the state of Maharashtra, so that when the sale happens from Maharashtra, it gets billed from my Maharashtra state registration, because it's ultimately a stock transfer. This is a big challenge for small suppliers. Big suppliers anyways have registrations across the country. These are the small suppliers who are situated in one state, but because the e-commerce operator predicts the demand and shifts their goods even before the actual sale has been made from one warehouse to another, which is where the problem was happening. And they were all trying to get a sort of a virtual place of business where they can get a simple registration into one state and then add the warehouse addresses of this e-commerce operator as an additional place of business. In many of the states, this problem was being raised. So if I take a virtual registration, of course, I would have one business premise, and hundreds of at least 200, 300 or 500 people or small suppliers would take a registration into this virtual place of business that I have taken. Now, if one person defaults with some sort of compliances, the officer would tend to then cancel everybody who is registered at the same business premises, and that was causing a lot of problems. Secondly, many of the states were very reluctant in granting the registration in first place to a lot of business premises within the same registration or the same business place, where different suppliers are having different PAN or entirely different business would get registered. It seems that the government has taken into consideration the challenges that were being faced by the e-commerce operators and the small suppliers, and I think that is what they are trying to address. If this comes in, it is going to give a big boost to e-commerce operators, and it at least resolve a lot of compliances for the small taxpayers who want to be in one state but want to explore the entire India market onto this e-commerce platforms.
Coming to my next question, it is regarding intermediary services, which is proposed to be removed. The section 13.8 I am talking about. So, what is it all about? Can you share some light on it?
So, intermediary services, specifically where intermediary is situated in India and he is billing it to somebody situated outside India. In a normal circumstance, for any other services, this would have been treated as an export of services and would have been zero rated. But there is a specific provision under the GST law which says that if an intermediary is situated in India, in that case, that intermediary will not get the zero rating benefit or the export benefit, and consequently the services will be taxable at 18%. This was placing them at a disadvantage because their services were getting costlier by at least 18% because of the tax that was being added, because the recipient was situated outside India, was not getting any credit. There were various petitions filed before Gujarat High Court in case of Material Recycling Association, Dharmesh Jani, there is a judgment in Dharmendra Jani, there is a judgment in Mumbai High Court, and people were challenging this as a violative of the Constitution of India, saying that it creates a disparity between the normal service providers versus the intermediary. Now, why this provision was there under the Indian law is because we have taken it from the European VAT, where intermediary is taxable, but then it sees what is the underlying supply. If the underlying supply results into an export, then it's also considered as an export. If the underlying supply results into an import, then it is considered as a taxable service. Whereas in India, whether the intermediary services results into an export or an import doesn't matter. Secondly, many service providers who are doing much more than facilitating a supply. Intermediary is somebody who is only facilitating a supply between two entities or two persons. But in case of entities who are GCCs, the global capability centers, which are coming into India nowadays, there have been cases where DGGI have raised notices on these GCCs and have been trying to categorize them into intermediary. So this sort of removal of the provision making an intermediary liable to taxation will benefit both people who are intermediary, the direct beneficiaries, but people who were not intermediaries but were still getting tagged and were getting dragged into unnecessary litigations will also benefit from this. So a very welcome move which has been represented to the council right from the start of the GST, and it has been taken into a couple of GST council meetings, but it finally sees the light of the day. A very good move from the government.
Agreed. Now coming to the most talked topic, that is IMS. There is a buzz around social media in LinkedIn, Twitter, that IMS has become mandatory.
And WhatsApp University as well.
Yes, for sure. So, and IMS has become mandatory from 1st October. So what is your view on this?
So why this buzz is around is not because of any GST 2.0 changes, but actually in relation to the changes that have been made by the Finance Act 2025. So the budget changes have been now notified along with these the rate changes of GST 2.0. So what has happened is the government has notified the changes to section 38 amongst others. The changes to section 38 is said that it earlier referred to an auto drafted statement, and now it has been, the wordings have been changed to only statement. That's the only change that has come. People are referring to this change that this auto drafted statement has been removed, which means that the GSTR 2B will now not get auto populated and one will have to generate the GSTR 2B through an IMS, which is why the IMS is mandatory. And because IMS is mandatory, you will have to compulsorily take accept or reject action. This is absolutely incorrect, hands down. What has happened is the government has only changed the wordings of the section, which says that earlier there was an auto drafted statement, now it's only a statement. Now what this changes? Earlier, because the word was auto drafted statement, IMS was effective from October 2024. Right. Now if on the 14th anyways the GSTR 2B was getting auto populated or auto generated, but because of IMS I could change my action, go back to the GSTR 2B and regenerate my GSTR 2B. That is what was not an auto-generated statement, because I was manually then generating subsequently. And the law, the IMS advisory allowed me to regenerate GSTR 2B as many number of times as I wanted. This was somewhere at a disparity between the law versus what the IMS advisory was saying. Now when the law says that there is a statement, it doesn't refer to an auto-drafted statement, your GSTR 2B will still get auto-generated on the 14th of each month, because there is an action called no action. apart from accept, reject and pending, or let me say this statement again. So apart from accept, reject and pending, there is also something called auto acceptance, which is deemed acceptance. Even if you don't take any action on your IMS, those transactions are going to be auto accepted and they will flow into your GSTR 2B. And your GSTR 2B is going to get generated automatically on the 14th, except for those scenarios which have been mentioned in the IMS advisory, such as you have not filed your returns previously or you are a quarterly supplier. In those cases, you will have to go to your respective, you have to navigate to the respective section of the GSTN and generate the GSTR 2B. But does this small change from an auto drafted statement to statement make IMS mandatory? The answer is no, not yet.
Right. You mentioned about section 38. People are also using section 34.2 and section 39 to derive at an answer that IMS is mandatory. So what is your take on section 34.2 and section 39?
So another important change is with respect to section 39. Now what section 39 amendment says is that you will be able to file GSTR 3B subject to such conditions as may be prescribed. That's it. And this is not being talked anywhere. Why? Because this only says that subject to the conditions that may be prescribed, and nobody knows what conditions are going to be prescribed. Now you have to take a step back and go to the minutes of the council meeting, the 55th GST council meeting, which gave a lot of inputs about how they want to make changes to make the IMS effective in terms of law. Since the IMS has come from October 2024, there has been and everybody in the industry have raised the question as to whether IMS has a backing of the law or not. The simple answer is no, which is where all these amendments have been coming in. The changes to section 39 are, it simply says that the GST 3B filing would be subject to the conditions as may be prescribed. But if you read the council minutes, they say that they will be introducing changes to the Rule 61, which would include a condition that you will be able to file your GSTR 3B only after your GSTR 2B gets generated. Right now, there is no such provision. And in fact, I remember one of the webinars that we were doing at Cygnet, there was somebody in the audience who asked us that, what if I want to file my GSTR 3B even before the GSTR 2B gets generated? What is the impact of IMS back then? I didn't have an answer then, but probably the government also understands that. And because their ultimate goal is to auto-populate your input tax credit from your GSTR 2B into just GSTR 3B and lock it, which is where this amendment is there, where they are saying that as per Rule 61, you will not be allowed to file your GSTR 3B before the 2B gets generated. So the sequence is, you take your IMS actions, you generate your GSTR 2B, that credit gets populated into your GSTR 3B, which becomes non-editable. Of course, this non-editing is not implemented yet, but this is in line with the government's vision of making GSTR 3B non-editable.
If that is said, then what about hard locking? If hard locking has been implemented, then automatically IMS gets mandatory.
No. So again, what the WhatsApp University or probably the updates on LinkedIn have been saying is that hard locking has been implemented, and probably they are referring to an advisory of the GSTN. That advisory that came in last said that the only one portion of GSTR 3B is going to be hard locked, which is your interstate supplies to B2C customers. That's it. That also has not been, although the advisory is there, that also has not been enforced on the GSTN portal. So while the updates do say that the hard locking has been implemented for the liability side, the advisory only refers to B2C interstate supplies, but that has still not been implemented, let alone the hard locking of input tax credit on the IMS. So I think the way this goes ahead is that they will slowly and gradually freeze each and every section of your liability side on the GSTR 3B. Then by that time, IMS will become mandatory with all the changes that come in onto under the GST law. And one thing I forgot to mention while discussing the amendments of section 38 and 39 is that to implement IMS or to make IMS mandatory, the government will have to come out with the rules. And if you see the 55th council meeting, they have referred to changes in Rule 61, and they've also said that they would implement a rule under the Rule 67B. So they will have to prescribe all this method under the respective rules. Section only contains the enabling provisions, right? The rules contain the procedural aspect. So the rules have not been notified, which is why IMS have also not become mandatory. So one will have to also wait for the rules for all these things to get mandatory. So I believe that the government would move ahead with freezing of outward liability on GSTR 3B, and simultaneously IMS would become mandatory through these rules. And later on, at a point of time, the government would now say that everything in your GSTR 3B becomes non-editable. Your liability gets populated through 1 and 1A, which is freezed, and your credit flows from IMS to GSTR 2B, that is also freezed, and we are not going to allow you any changes.
Right. So coming to section 34.2, where the government has specifically mandated that credit note reversal can only be adjusted after subsequently the supplier has reversed the ITC. So there is no mechanism prescribed yet.
True.
So people are assuming that IMS is the prescribed mechanism. So how will you?
So in all probabilities, IMS is going to be the mechanism for it. But if you read the amended section as it stands today, it says that the supplier will be able to reduce his credit in two scenarios. If it's a B2B supply, then he will have to ensure that the recipient has not availed, and if he has availed, then he has also reversed the credit. And if it's a B2C supply, then he has to ensure that whatever benefits has been passed on to the B2C, or the tax that has been passed on, no undue benefit is being claimed by the supplier. He is not retaining any undue benefit, which is known as unjust enrichment in the legal parlance. Now, coming to the first point, where I am making a supply to the B2B customers, it is a gray area as of now. The government intends to restrict this or ensure that the reversal has happened at the recipient's end. The supplier knows this through a mechanism. Right now, it is being done through a circular of an old circular, which has again been, which probably the government would withdraw, or has it been withdrawn? That is the one that has been withdrawn. Sorry. So right now, this mechanism was being enforced through a circular number 212, where the supplier was supposed to get a certificate from the recipient as to whether he has availed the credit or whether he has availed and reversed the credit. If on the basis of the certificate issued by the recipient or his chartered accountant, considering the amounts, the supplier was able to reduce his credit, or at least this is something that he had to produce at the time of audits. Now, it is very evident that this reduction is going to be done through the IMS, but as I said earlier, the rules have not been notified yet. So there is a gray area because there is no mechanism right now. If in the month of October, if you are raising a credit note to your recipient, and let's say the government still doesn't notify any rules, it is actually a problem where the supplier wouldn't know whether the recipient has reversed it or not, and he doesn't have any mechanism to know this. But I believe in all probabilities, the government would notify the rules soon, and that those rules may be made effective from 1st of October. They normally do that. The rules are made effective from a previous date, wherein they will notify that if the recipient eventually accepts the credit note in their IMS, then in that case, the reduction that the supplier has taken would be through. Because you have to also understand that when the supplier raises a credit note in his GSTR 1, that gets populated into his GSTR 3B, and we are also talking about that hard locking, etc. Yes. So if this credit note gets auto-populated into my GSTR 3B, even if the IMS is made mandatory, I will come to know that my recipient has finally accepted that credit note and file his GSTR 3B only when he also files the GSTR 3B. But that's when also I will file my GSTR 3B. So there's no mechanism for me to verify within that month only that my recipient has reduced the credit. Same goes with the other provisions where the recipient is also mandated to know that your supplier should have paid the tax on the supplies that are made to you on which you are taking the credit. There's no way for me to check this. In those cases, it is said that you verify it on a later basis, or on a post facto basis, you can verify this fact. I think those similar kind of provisions would be brought into the rules, wherein they would say that you later on see whether in your IMS, if the recipient has accepted, then you have validly reduced your liability. And anyways, the IMS, I believe the way they will implement is that if the recipient rejects your credit note, that in any ways gets added to your liability, and the mechanism of section 34 gets taken care of. The only challenge here would be the interest, which I don't know what would happen to it.
Right. I think the IMS is not mandatory, and it is clearly a myth by the answers you have given.
Not myth as yet.
Yes. But if we have to see the practical challenges for adoption of IMS when it becomes mandatory, so what is your view on that? How will the industry adopt IMS?
I think if as an industry person, you are not following IMS as of now, I think it's high time to start following IMS. People who have been doing it, they have been, sort of having a dry run, or they have had their net practice with how the entire IMS operates. And people who have implemented the technology solutions where you can take bulk actions using software, where you can, directly take an action based on the reconciliation items. Say if it's matching, then you put it into an accepted bucket, and if it's say only in GSTR 2B, not there in your purchase register, then you mark it as a pending statement. If you have been doing that, then I think you are properly placed. This IMS being mandatory should not affect you to a larger extent. But if you are living under the rock and you have not yet implemented IMS, I think till the time the government comes up with the rules and makes it mandatory, I think you should start implementing it and having a look at that.
Right. So said that the people who have not yet started this thing, IMS, so what steps should they immediately take from here onwards?
I think the first step they should start taking is start visiting your IMS portal, have a look at how different actions such as accept, reject, pending would be taken. Of course, if they are not following it, everything would have been auto accepted by now. One challenge that they would face is if they have more than 500 line items,
Yes.
which would be the case, they would not be able to take bulk actions or at least view those transactions onto the IMS portal. So look out for vendors who can give you those automated solutions where you can take bulk actions. And last but most important, I would say, is there is also something called supplier view. So if my recipient is rejecting my credit notes, then it gets added to my liability. So as a supplier, it is also important for me not only to take actions as a recipient, but as a supplier also to view what my recipients are doing, whether they are accepting my invoice, whether they are rejecting my credit notes, what they are doing. If you are rejecting their invoices, in all likelihood, they would also not make a payment to me because they have not accepted my invoice. In that case, I should be proactive and have a look as to what sort of documents are getting rejected and then take a proactive action.
Right. That brings me to my last question. Any keynote you want to give to the professionals who are going to face IMS in the coming time?
Yeah, I think similar to the industry, the professionals also should, first of all, get a clarity on what's happening. So there are certain amendments also that are coming onto IMS, right? They are right till now credit notes, downward amendment of invoices, downward amendments of credit notes where the earlier credit notes were not accepted, so on and so forth. There are 5 documents which were not being allowed to be kept pending till now. These documents are now allowed to be kept pending for one tax period starting from October. That is also a very big amendment. Second is, while accepting a credit note or any of these 5 documents, you can select as to whether you want to reduce a full ITC or reduce partial ITC or not reduce it at all. And the third big amendment is that you can put remarks in the different documents. Specifically, when you reject or mark a pending action, you can put remarks which will be available to view by the supplier in their supplier view. So these are all the amendments as well. So professionals should, brush up their knowledge right from October 2024. Actually see what amendments have come in, guide their clients accordingly, and not, go ahead with the myths that have been floating around in the market, and help the client get enabled to implement IMS. I think it's only a question of when it is going to become mandatory and not if. It is certainly going to be mandatory, and I feel it's about a couple of months time, if not 1st of November. My gut feeling is 1st of November, but let's see. That's my personal gut feeling, no insider information from anywhere, but let's see how it goes through.
Thank you, Tapas. Thank you so much. Thank you for sharing your insights and taking out the time. I am also like to thank all the listeners. We are coming up with another 2 episodes which will be specifically covering industry sector-wise rate changes and the operationalization of GST in the coming period. So please stay tuned. Thank you.